My name is Richard Bergalt. I have a couple of colleagues here that I work with every time. They have their bright and shiny, happy faces will be here, making sure that I don't say anything wrong, or if I do, that they correct me. um, I've got here Don Paulin and John Denovich. Don, why don't you go ahead and just introduce yourself first, and then we'll go on to John.
My name's Don Poland. I'm a CPA. I've been working in the space for quite a while, and historically been in the tax space for about 25 years. So I have my own company, and I work closely with John Denovich and Richard as well.
John?
Very good. My name is John Denovich. I'm with the Jennings-Denovich Group. Been in the cost segregation space for about 25 years, and have known Richard for most of those years, and worked very closely with Dawn. So we're actively in the space, and we network and keep ourselves plugged into the latest and greatest, things that we need to know about cost segregation and 179D.
Cool. Well, thank you guys for introducing yourselves. Much better than I can do. Okay, I think we can kind of get started. So the idea was to tackle here first, 100% bonus. Some of you guys are in the ASCSP, so you might have, had a nice lengthy discussion about this already. But, some people here probably haven't heard anything about this. So we're going to kind of go from the basics. If anybody has any specific questions, please, write them into the chat or hold them for the end, or just let us know you have a question. But yeah, so 100% depreciation is back with the One Big Beautiful Bill Act. Why don't we go ahead and just start with what your top issue is, Don and John. I'll just go to you guys first, and we'll just talk about, like, what do you think either the most insightful, what is the biggest impact here, or what is the biggest kind of like curveball in it, or anything like that, anything interesting?
I'll let Dawn, talk. Dawn is a CPA and been a CPA for many years. And I am not a CPA, but I'm in the trenches doing cost seg work. And I lean on people like Dawn, and that's why we partner. So I'll let Dawn, lead off.
Okay. All right. Well, okay. So everybody was awaiting the 100% bonus. Even people who don't understand what 100% bonus is, they know they're waiting on it. They know they want it. And so when you're in the space of working with clients, you're really the conduit. I call that, you're the one who's telling them what Congress is telling us. And so right now, the hardest thing is to explain to people, where the January 19th date came from. So if you acquired property after January 19th, you're good. If you acquired property before January 19th, you're not good. You will not get 100% bonus. And then the acquisition of which, there's rules around that, what that means with binding contract. So we basically have to figure out for all of our existing clients what they will get or what they won't get, or sometimes be the bearer of bad news. So if they had like a construction project that they just wrapped up, and now, they wrapped it up in May of 25, we have to say, hey, I know you thought you were going to get 100% bonus, you were waiting on it, but you are not. That's the hardest thing about this, is to kind of be the bearer of bad news, and then have to make that decision. And then sometimes the argument that sort of ensues with the client about that, because like most construction projects that are wrapping up now, they started well before that pivotal date. So they will not get the bonus. They will have to follow the old rules for 2025 and take 40%.
Okay. Yeah. So that we were talking about, things like that before the call, where we were saying, hey, look, where are these lines going to get drawn? And there's a couple of interesting not loopholes, sorry, but interesting points there, right? So we were talking about, for instance, contract date, versus when they bought the land. And and then also safe harbor under how much of the contract was completed by 120 or not. So there are and sort of our conclusions on those specific things were okay, as long as I think it was 10% was done, only 10% was done before 120 on a new construction. You're safe to sort of push them into the 100% bonus eligibility. But if more than 10% was done before that, and this would be done by sort of percentages of total contract up to that point, then it wouldn't be eligible. Are there any questions specifically there, or any points anybody else wants to make?
Richard?
Yeah.
Hey, it's Andy. Quick again,
Hey, what's
just to
up?
reiterate that it's 10% of the total cost of construction at bid. Clearly, there's going to be overruns and changes in most construction projects, but if they had a bid for 500 grand, if they spent 49,000 before that, they're good. If they spent 51, probably not. Right? I mean, that's a hard line, but
That's where it gets tough, is to really making that determination, and maybe you have to wait for the project to be completed to understand what 10% really was. Because, like, yeah, you're right. Actually, if they have an overrun, then that number might be now less than
And
10%.
it's a little bit of a gray area, so you'd be talking to your CPA. But Andy, some of these things, like what doesn't count, which will still be on your pay app possibly, is the soft costs, engineering, architectural fees. Those, we're talking about shoveling dirt, actual work that was completed. So these transition rules have been, that didn't change. Bonus went to 100%, but the transition rules have not changed. And the transition rules we've dealt with back in 18 with TCJA. We've dealt with it when QIP came out. Over the years, those transition rules don't change. So it gets a little bit of an interpretation in that consulting, like as you being a cost segregation engineer, a company that's providing, you have to consult with your client, and you literally are taking pay apps from that period, and I don't think you drill down so far as you do the math, oh, I got to have final cost. Now, again, it depends on whether you're getting audited or not, right? It's like you got to take out the architectural, the engineering, and all of that. The mobilization. Mobilization. What is that? It's just getting your stuff on site. It's not breaking ground. And so there's always that give and take with your CPA. Oh, okay. Well, so we're talking about 120. I need to see your 1231 pay app. I need to see your your January pay app, February pay app, you know what I mean? And then you go in and you look at those numbers. And usually it's very few that, just that get to that point where, oh, we don't know what to do, oh, we're going to do the math. Very few of them. And again, as I was mentioning before the call to everybody, it's like this, we always go through these transition rules. A year from now, we're not going to be worrying about it so much because buildings take about 12 months, pretty much start to finish. So a year from now, we're not going to be worrying about that. But for new construction, I need your pay app, okay? And on the pay app, right at the top, it'll have a contract date. But I can't tell you how many times you will get a pay app and there is no contract date. It's blank. It's blank.
Especially in the transition period.
Yeah, so you got to deal with that kind of stuff. And then one thing that we haven't touched on is the purchase. The purchase, you have the contract date, which is easy for, give me your pay app. What's your contract date? Is it before 120 or not? And then you look at your 10% safe harbor. For purchases, you're looking at the sales agreement. That's your pay app. Like you make an agreement to buy something. You have your settlement date, which is usually a place and service date. Generally, if you buy an existing, say, hotel that's already operating, obviously your place and service date would be your settlement date. But then what's the second part of the test? That's the sales agreement. And it's not the first sales agreement that you sign on the dotted line. There could be revisions. It's the last sales agreement. But if you're really trying to tie a bow around it, whether you're eligible for or not, you need those two pieces. What's your place and service date? Obviously, it's got to be 2025 after January 20th. And what was your contract date on new construction? And for purchases, what's your settlement date? And what's your sales agreement date? And you would have to have those in your file if ever audited to prove that you were eligible. But as you know, there's not a lot of audits. And a lot of times what happens is you consult with your CPA, you consult with your client, And then it's their appetite for exposure, whether they want to go for it or not. It's just a timing thing. If they do get audited later and they can't substantiate that, they're just going to, they'll move them back to 40%. Just change your depreciation. So I hope that makes it a little more clear.
Yeah. Yeah.
Is
To
that
your point,
is
to
that
your
10% accrual base or cash base?
I think it's
Like, is
cash.
it-
So it's,
Okay, so
cash.
explain.
actually it depends. If you're accrual, then it's when it's accrued. If it's
Oh.
cash, it's when it's paid. So you're gonna follow that. It could be a difference if you're an accrual
Okay.
based taxpayer versus the cash. Yeah.
Andy, go ahead.
Well, in the
Sure.
instance that 100% doesn't apply on a new construction, you revert to 40. But to John's point, that's going to become a moot point in a year or so, right? I mean, it's
Yeah.
just not going to be an issue. So you will have some trickle in for 40 with placed in service on new construction after 120, but that'll obviously go away as time goes on.
And that's what kind of happens out there in the field is, well, if you've been doing it a long time, you kind of forget about this stuff because a year from now, you don't have to deal with it. But whenever new legislation comes in, the next regime or whatever, when they change it again, you've always got that transition that you got to deal with in the beginning. And like Dawn says, people don't want to hear it. We just got recently we did a project for someone and they placed it in service in February of 2025. And boy, as soon as that bill was passed, we got the email. Could you rerun that report at 100%? And we go, well, your contract date was a year ago. It was last February, so you're not going to be eligible. They don't, like Dawn says, that's tough news too. But all you can do is just say, hey, look, we're here to protect you, from exposure. And basically, the CPAs will book it any way they want.
Yeah, that's true.
Yep.
That's true.
Some CPAs on this call too, so you know that.
Yeah.
Besides Dawn.
Oh, you mean there's
I-
other CPAs other than Dawn? I thought she
No,
was...
Dawn's the only one. I don't want to disabuse you of that notion, John. There's a John lives in San Francisco, everyone.
Yeah.
Okay, so I actually thought of something that, and maybe it occurred to somebody else too, is it said like, this seems like a perverse incentive for change orders, because you guys are saying, so I would have thought like before the call, I just assumed it's going to be based on the contract amount, like the set like the opening contract amount. So you guys are saying this could change based on the total cost of the project. I mean, anybody who wants 100% bonus seems like, they're just in for the number of change orders it takes to get them past, 90% after 120. Does that seem like something?
You don't really get as many as you think you might get. There are very few
Right.
that are on the line. I remember the last time in 18.
But you could, let's say that. I mean, just
You
devil's
could.
advocate here. You could totally do that.
You could.
In your view.
And so that what would maybe the CPA might take the position of, this was our contract. I don't care about change orders. They're not splitting hairs. You know what I mean? So.
But in your opinion, I mean, that's defensible under the statute, under the new bill, right? Because it's like, if you're taking safe harbor into account, for instance, and you were able to like stretch out, let's say it was a $500,000 project and you did 200,000, before 120. And then, you do another, let's say 500,000 in change orders after that. Well, that 200, well, sorry, no, another million, let's say after that. And it puts you past, that you're at 90% or more, after that date. So, to you, if, obviously this might never come up. I mean, I like these kind of devil's advocate things because they're the kind of stuff I think of. To you, I mean, that's defensible, right? Because you're like, well, the total contract was $1.5 million and they only did 200 up to then. So
yeah, you're always building everything you do when you do cost seg is, you accelerate, you decide not to accelerate something, an asset. You're always saying, how am I going to defend this? And so again, you're not going to have, you're going to have final costs, when you do the study, because, you're tying it out, to place it in service. So you got to have your final cost. So my guess is you're probably right, Richard. It's probably total with the change orders and everything.
I was actually wrong. Even that wouldn't even 1.5 million wouldn't even be enough. So anyway, they would have to add substantially to their contract So yeah, I mean, you're right. I mean, you're going to have, a very few number of people adding that much substantially to the end of their contract just to get this done. Unless they were just planning on doing like maybe they were planning on doing a big renovation, or plus spending more money later. And then they're like, well, we might as well just spend the money now. And, anyway, okay.
Well, what happens in real life is, you're talking to your client and you say, when did you break ground? I'm not talking about your architectural. I mean, when did you guys start moving dirt around? And they know that date. They know that date or close to it. And generally, you really have very few. I mean, I think all of our decisions over the years have always been pretty easy to make. We weren't really in that, oh my God, what are we going to do? We're so close,
Yeah, I get that. I think maybe across the industry, there'll probably be a few, right?
Yeah, there's
Instead,
gotta be
it's
a
like,
few.
like one singular practice or one singular firm isn't going to see too much of this. You'd see one at most, maybe, and then okay, it comes down to the whole consultation thing. Okay, we'll move on a little bit here to QPP and just kind of talk about the intricacies there. We had a little bit of a conversation before the call about, okay, what does it actually mean and what needs to be done? Because I hadn't been fully read in on it, and it stated there, and Don, why don't you go ahead with this? But it stated that you do have to carve out the pieces that are not explicitly part of the manufacturing process. Is that right?
Yeah. I mean, it does say that. I mean, the whole bill is geared towards trying to get manufacturing to come back to the US. So, this particular portion of the bill is a whole new maker's class for qualified production property, just for manufacturing facilities. There's rules around it, like everything else. You have to start construction after that January 19th date, and then be building a manufacturing facility in the US. And then they essentially have to be owner occupied. They don't want a lessor-lessee relationship, and that's one of the areas where we're going to need some more guidance, because generally, and I wouldn't say generally, I would say 100% of the time, even an operating entity is going to have their real estate in an LLC. Every lawyer will tell you to put each piece of real estate you own in an LLC for protection. So then you're going to naturally have this agreement, whether you do a grouping election to bring them together, or for your businesses, maybe you have to do that, where you've got one entity paying the other one, even though they're related parties. So, but the idea is production facilities that create a product through a substantial transformation, which is another interesting thing, can be 100% expense. So you won't really need to do a study, unless though some of that space is cafeteria, sales, leasing. If it's not manufacturing something, if it's doing another function within the building, it's excluded. So you'll have to exclude those portions.
Break room.
Break
Locker
room.
room, right?
And it may not even come down to being as easy as just bifurcating your cost on a square foot basis, because you may need to look at electrical load. Your electrical load for your mechanical and your manufacturing space is going to be a lot higher than for your sales and your office activity. So I think a study is going to be needed to sort of really properly weigh all that stuff, properly document all that stuff. But in the case where you have all of your manufacturing in one building, and then you have a separate little building for your sales and your office space, then it would be easy. And it's all your real property. It's every single bit of it. So it's definitely nice. It's only for a period of time, I believe. It's like a 4-year period, basically getting through this administration's term. But we'll see how much it really, brings back manufacturing. But that's kind of the idea around the qualified production property.
Yeah, and in that vein about bringing it back, and this was something that John mentioned earlier, before we came on, was one of the rules, the main rules, and just for everybody who hasn't run through it, is you can't have a manufacturing facility and then be like, okay, we're placed, like we've done like a renovation of this manufacturing facility, and now we're going to take all of it in 100%. That's one of the rules, is that it can't have already been doing manufacturing. Somebody
In that case, though, you would get QIP, so you don't really care so much.
But you don't get all the real property, though.
you don't get the real property, but in a QIP situation, not that much of it is
You're getting a
generally
lot.
property. You're getting a majority of it. I mean, I think one of the
You
things
mean in a
can't
renovation,
do
right? Yeah, in a
in a
renovation, you're right. I mean,
renovation,
yeah, exactly. But if
but
you, yeah,
you could take an existing facility that was never manufacturing before and transform it to manufacturing, and that counts. But it couldn't have been a manufacturer. I guess they just want new. They want new manufacturing. So you could take an old grocery store, something big, big boxy, and make it now a manufacturing facility. But substantially transforming a product, the first question I think of is that now who's going to substantiate that? Is that going to be the cost seg professional? Is that going to be in our cost seg report to say that a substantial transformation has occurred in this facility, making it now qualified production property? And it doesn't, the bill didn't say what rules you look to for that. I mean, my thought was you look to like R&D rules, because those, but then I was talking to somebody else and they said you look at subpart F rules, which I would have to look at what those are. That has to do with foreign. I'm not sure about that. So I will say that usually when the transition rules or more guidance comes out from the IRS, it will simply usually be pointing to other areas of the code where these items are already defined. So where that's going to point to, I'm not sure, but I think it's probably already exists, but that's a question mark.
yeah, is folding paper substantial transformation?
Yeah, no.
What about cutting it? What about cutting paper in half?
No. If
Okay.
you took it, I would say that. I mean, I'm just making this up, but if you took the paper and you put it in water and you dissolved it and you took the pulp and then you added other ingredients to it and
Okay.
you made it now decoupage or something.
Oh,
Now that's
you're the only
me.
one here who knows what that means, but okay.
I think it's a
What
crafting
is
thing,
it?
like glue.
Okay. Okay. I didn't mean to speak for everybody, but I honestly have no idea what it is, but okay. Okay. Anybody have any questions there or anything to add there, John, maybe before we take a question?
No, other than the fact that even people that have been in this space for a long time are really looking for guidance for QPP and not expecting guidance for another 6 months or so.
Okay. So yeah, so I mean, look, we're expecting that there will be guidance to kind of further the understanding of these rules. Does anyone have any questions on? I do. Actually, well, I'll just throw it over to you guys. Should we? Are there more things to explore here with the One Big Beautiful Bill before we move on? And then we'll also anybody who has a question about anything concerning the One Big Beautiful Bill, we'll try to get it in now before we move on to any other topics. I know I have a question in an email that I'll just look up the question in the email and we'll try to get it done before the.
I think John has a question too. John Epperson. He just.
Yeah, just
John.
I kind of had a little trouble logging on and hearing, but I just wanted to make sure I'm looking at in the past, the 100% bonus depreciation. It had a maximum. Now, does this have a maximum that's allowable for bonus depreciation?
No,
It's
there's
not-
never been a maximum.
Yeah, I don't know when you saw
Okay.
that previously, but yeah, no.
Okay. And let's see, just a couple questions as you were talking about it. Now, are you insinuating that this is only for manufacturing? Is that what the bill is referring
No,
to?
sorry, that's a special makers class QPP. It's a new
Got
makers
it,
class
got it.
for so qualified production or sorry, manufacturing or its production property is 100% of that portion, which is different than 100% bonus. Bonus eligibility depends on depreciable life. If it's 20 years or less, then it's eligible for bonus. It also has to be that for eligible for bonus. That's why you do a cost seg study, and then you can take that part. If the part for QPP is better than that, it actually, if you built like Don said, maybe you have an office off to the side and you just build a manufacturing building, everything, the foundation, the grading underneath it, everything about it can be 100% expense, which is never the rule with 100% bonus.
Okay. And then just one more quick thing. Now, the previous one dropped off to 80%, 60, and I know it's just for the next remaining 3 years. But does it stay at 100%? Am I understanding that correctly? It doesn't drop to 80?
It stays until they change it again. So it's
Yeah, got it.
permanent
Okay.
until it's not permanent.
Till 2030, I think, right?
Till
Isn't it?
2030.
Is
I
how it's
think they
written?
can
Yeah.
only legally make
2030.
it through the current budget reconciliation period. So
Right.
it's that timeline.
Okay. Well, it sounded pretty good for us to not get political here. It's sounding pretty big and beautiful to me. Anyway.
Who would have known that big and beautiful would be such politically charged words?
Yeah.
Yeah.
Well, they
Anyway.
are. But okay, thanks, John.
Thank you.
Yeah. Yeah. Anyone else right now before we move on to the next topics?
Yeah. I had a question regarding a primary home that's converted into a rental. So I came on a little bit late, so I don't know if it was discussed, but just wanted to ask.
No, we hadn't gotten to that part yet.
Yeah, I think that's our
Okay.
next topic, isn't it, Richard?
Yeah, it is our.
it's
It ours,
timely.
Oh,
I believe that's the next topic. So
Okay,
you're
so,
kind of
so I'll
timely.
just wait for it.
Okay.
Perfect. I'll just
Yeah.
wait.
So why don't we'll just take that away there, Don, because I know I think that was something that we had discussed as bringing up as a topic.
Yeah, this comes up often, actually. A lot of people ask about converting a primary home. You know, you've lived in it and then you're going to move, but you want to keep that house and now you want to make it a rental. You know, how do they capitalize and depreciate that? What year they use, etc. So what they need to do is they bought the house, let's say in 2005 for a dollar amount. And that's the dollar amount that is going to be their basis. And they haven't used that in any business purpose. They haven't depreciated that at all. So it's that full dollar amount that they paid. And then, I mean, maybe even including like any subsequent renovations, you know, they would add to that. Then they would take all of that money and place it in service at the time that they start renting. So, you know, now it's going to be placed in service like in 2025. And that's when they would start renting it. And that's how that would work. Now it becomes a business asset. A lot of times you would now transfer it to an LLC or something. But monetarily, you would not take fair market value as of today. You're going to take whatever your purchase price was historically, because tax does not work on unrealized numbers, unrealized gains or losses or anything. It is only actual factual dollars transferring hands. So that's one big thing that people get confused about.
And bonus is when? When is the date for eligibility for bonus?
So that would definitely preclude them. Like unless they, you know, in that case, they're not going to get 100% bonus because they purchased it a long time ago. So those are the people for sure that are going to have to follow the old bonus rules, which I mean aren't terrible. You know, you get a lot of your benefit just in years 2 and 3. You know, you just have more of a dip like that because your 5-year property is generally your largest number. So in that being double declining balance, it's not even straight line. So it's tipped more in those early years as well. So they don't have to wait too long for it. It's not too big of a deal.
But the actual rule here is it's when they convert it, that it will be the date that will be their eligibility for bonus or not. Just to clarify.
Well, yeah, okay. So yes and no. So I'm gonna say no, they have to look to you have to acquired. So when you're looking at the bonus rules, the new bonus rules, the 100% bonus rules. So historically.
Sorry, I said that wrong. My bad. I said the exact opposite of what I meant. Yes.
Yeah,
Okay.
what you meant. So,
go ahead.
So historically in the bonus rules, we've never had to look per se to our acquisition date. We've only looked at place in service date. So this is a new rule with the big beautiful bill that we haven't had to really deal with before. So historically, like if they had put their into service in an 80% year in 2023, let's just say they bought it in 05, they placed in service in 2023, they could take the 80%, no biggie. They would never have to go back to like the 05 rules or anything weird like that. But it's only now that they want to take the 100% bonus that we have this transition that if they place it in service in 25 after that January 19th date, that they're going to have to go back to the 40%, if that makes sense. Now, if they place it in service at the beginning of January or even last year, you know, it's just, you just go by the place in service date. But now we have this second question. If they're placing it in service after January 19th of 25, you now have to say, when was this house acquired? And so that's going to hinge. And you will have to most likely override in your system. Or, I mean, right now, I know the softwares haven't built it in, they're gonna have to ask that question. What was the acquisition date and the place and service date? And then take, take both of them into consideration.
It's a very complicated problem, but SegStream does it for you. But that's all I'm gonna
It's
say.
complicated. It's complicated. I can tell you some of the softwares, and this happens, that they
It
don't
does.
quite
We
work.
changed it.
Yeah. So it will be up to the CPA to make sure that that's right. And there will be mistakes. I knew one of the biggest mistakes I see well, we'll get to this in short-term rentals is they're not depreciated over 39 years, which they should be. So there will be a lot of mistakes for this too, that a lot of CPAs or people who aren't watching, they'll just take 100%. So they just could have audit risk.
Hey, Don, it's Andy. The distinction again between acquisition date and placed in service date related to the application of the bonus. Repeat that one more time. What's the trigger there, or the?
So really the rule came about with this big, beautiful bill. So in the date in that
It changed with this, is what you're saying. It was
changed with
previously,
this.
it was different.
Before, we didn't have to worry about acquisition date. We only worried about place and service date. But now, if you wanting to do the 100% bonus rules and you want to place it in service after that January 19th pivotal date in this bill, which everything acquired and placed in service after January 19th gets that 100% bonus. You then have to ask them the question, okay, I know you placed it in service after January 19th, but did you also acquire it after January 19th? And if they say, well, no, I bought it at the beginning of January and then I placed it in service later because I did some reno, that's going to be a very common scenario. Most people buy a rental property and then they do a little reno or do a little painting and put it up for rent like a month later. They're going to want the 100% bonus, but you're going to have to ask that second question to really see if they can get it.
You're saying that
So to
that's
just put it-
disqualified.
It will disqualify them. They're going to have to go back to the old rules. They'll still get bonus. They'll get 40%. Yeah.
Okay. And,
Well,
and how many? Yeah, the acquisition's pretty easy to see from a closing statement or something like that. Placed in service is the fuzzy date, which can change, which most people will push past January 19th and say, yeah, it was the 20th, 21st,
Yeah,
22nd, whatever it was.
which is why you got to ask now for sure.
Which is why you got to ask.
Yeah.
What's interesting though, Andy, is that most people have already done it and they've already told you, like John was saying, we've already maybe done some studies, not a lot, it's 25. So people will wait till right before the returns due to get their studies done.
Yeah.
But the facts have already fallen into place. Now, whether they want to try to fudge them, but the closing statement will be the closing statement. But technically it's not the acquisition date of the closing statement. It's actually the binding contract date, like John was saying. It's actually when you signed the agreement to buy the house, and then there's rules around that. So, which I would just say generally is going to be 30 days before closing.
Got it. Yep. Thank you.
You're welcome.
Yeah, thanks, Andrew. Usher, did we answer your question there? Or
Yes, no, you did. Basically, it's
Okay.
what I suspected, which I'm not happy with, but what could you do?
yeah, you and all half your clients that are thinking they were going to make a move right now.
Yeah, it's a big bummer for someone. Yeah. So
Yeah, I've already heard from a bunch of people about this, and they're like, it's place in service, middle of the year. When'd you buy it? 2 years ago. Like, did you really sit on it for that long? Anyway, that's that. I had a question from Rob Lipka in the chat. And Rob, why don't we just have you come on and just kind of ask it in real time? Because I didn't know exactly. It must have been pertaining probably to the big, beautiful bill. Is that right? Or if you can't talk, Rob, maybe just.
I can. So the question is this. So from what I understand, there are some rules regarding binding contracts that could certainly make whether you get 100% bonus, 40% bonus, or 0%. And I just wanted to find out if you knew anything more about that.
And we're talking about one big, beautiful bill, yes?
We are talking about one big, beautiful bill, yes.
So more than we've already kind of touched on as far, the binding contract is your acquisition date. And then, what defines the binding contract, it's kind of questionable. And so it's usually, I guess, it's kind of determined under, state law, whether it's binding or not. Or I think the easiest way for me to think about it is, can you get out of the contract easily? and with, not that much loss of blood on your part, then it might not be that binding. So if you really have to go through with buying the property, or you're gonna have a large loss, which I think there are some rules in the prior transition rules with acquisitions around that, then that's what you're gonna look to for your binding contract.
Okay, that makes sense. Thank you.
No problem. Thanks, Rob. Okay, does that kind of cover converting a primary residence into a rental at this point, or other questions about that?
Richard, I had a quick question on that, I guess, if you guys can hear me.
Sure. Yeah, go ahead.
Didn't the acquisition and place in service date requirement start with TCJA? So like if let's say you bought a property in 2014, used property, converted it to rental in 2022, a year of 100% bonus. We're not even in the realm of the old BBB. If you acquired pre 9/27/2017, you fail that acquisition test. So you convert a
Don?
rental property in
I
2022.
think you're right. I think there was, John, do you remember? I think there was so what I remember, and I could be totally wrong, I feel like there was an acquisition test for sure, but I don't know if it was and placed in service, because obviously you can't place it in service until you've acquired it. So it's actually a little funny that there's both.
I think
But
those transition rules were never changed, and I remember going through it in 16, with QIP. I remember, all these different.
do you remember
standards.
specifically around the acquisition question?
Yeah, it's like, which rules do you follow?
Binding contract.
Do
Yeah,
you
I think you're right,
follow
though, Jonathan.
it's like the old rules, new rules, but yeah, it gets kind of crazy because but we've been dealing with it right along. It's always been a kind of a two-part test because again, the spirit of the law, if you want to call it that, is we're writing into law certain advantages for real estate folks, and it's for moving forward, not stuff that was already in the can, stuff that you'd already done. Oh, I got lucky, now I just fall into this. That's what the transition rules, I think, were meant to do to me. It's like only new stuff, new stuff. You take advantage of the new law. It's you're trying to generate tax advantages and trying to promote, more building, more of this, more of that, more manufacturing, but there's always that little gray area when they pass the law, we've always had to.
So not to break in here, but I think, so Jonathan, it sounds like you're right here that this did exist at TCGA too. It's like, you can't have bought in 2010, placed it in service in 2018 and reap the 100% bonus. That was the law back then too.
Correct.
Yes,
that's the way things have been.
That's the first time we've had. I
Yeah.
feel like it's the first time. I know we looked at it for new construction projects a lot, but you're right. There was an acquisition before, but it is easy to forget as the years go by, and then you got to dust the cobwebs off, as John's saying.
Well, I know that came up when we built our product too, and I remember we actually had to put that in. So yeah, I mean that is the way that it's been handled in TCJA too. But thank you for bringing that up, Jonathan, to clarify, because yeah, you're right. That was the rule then.
That'll make it easy though to come back and look at those rules for sure.
Yeah, and I mean, I know even in our case, I mean, I'm sure as many of us have seen this whole, hey, a place I used to occupy, I now rent, has just exploded in the last couple of years. There's a lot of it, and I mean, when we look back on our team, we're trying to even think, God, did we even maybe not look at a couple of them the right way? But yeah, I know lately we've been kind of following that acquisition date part, and so if they bought it in 2018, lived in it till 2020, converted in 2020, then we've been saying that they've met acquisition and placed in service, they get 100%. If they bought it in 2014, converted in 2020, we've been saying no bonus. Just more so trying to just be safer, conservative, and I'm not sure for everybody on this call, like how many are with CPA firms, small firms, private firms, at the end of the day too, some of you guys are going to see each firm or each, team can sometimes, have their own positions. It's just more so to be aware that there is going to be variance out there. People are going to perceive things differently. I've come even from all the way from KPMG, not to be confused with KBKG, but big four firm, and they would even say that 95% of purchase agreements, like let's say somebody entered a purchase agreement to buy a duplex December 27th of 24, and let's say they didn't close until January 27th of 25. So they met the, or according to like what Don's saying, what I would agree with here, there's a purchase agreement in place that would fail OBBB, Big Four would say, no, you could walk away from those purchase agreements and not be penalized. So they're not really binding. They're intended to be binding, but they're not. I don't agree with that. But the point is there are firms that are out there that will say we can support that it's not binding unless there's a clause in that agreement that says you're buying this house no matter what.
Yeah. Well, isn't there like usually like escrow money you put down, you're going to lose that if you walk away, right? But you can still walk away.
Exactly.
I mean, it could be that they have big enough, insurance policies and legal departments that are happy to go to bat for those types of.
For sure. For sure.
They're happy to get paid to go to bat.
Yeah. We definitely follow what you talked about before, Don. No, we were actually just talking about this morning. It's the page we're on right now. We were thinking the same thing. We're like, hey, we're going to be working on some new construction projects, even this summer that we're going to find pay apps that probably started in October of 24. They probably need to raise a red flag on that. And then I'm not sure whoever else commented on it, but the point is let's fast forward a couple of years. This stuff's going to become so old and irrelevant, kind of like we've already all forgot about the acquisition rules of 2017. If we just don't come across it anymore, we don't see a pay app anymore that was signed in July of 2017. It's just time moves on. It's a little transition hiccup we got to work through, and that's it.
Yeah. Well, I see an interesting comment here, and from a guy who knows, he's bought a fair bit of real estate himself, and Mark is saying that no court would force a buyer to buy. It doesn't matter what the contract says. Now they might lose their money though. Would you agree with that, Mark?
They could lose something, or what John was saying, escrow, whatever. But yeah, that's exactly what,
But he's saying no judge is going to be like, you have to buy this house.
Exactly.
Or this, whatever it is.
Which is where, KPMG was holding the position of like, sure, a purchase agreement could say this contract is written in binding, but from the binding perspective of the IRS rules, it's not binding enough that you can't get out of it for the sake of a tax law.
But
I think this kind of hit hard. Oh, go ahead.
I was just saying, one of the webinars I was recently on mentioned a 5% liquidating damages penalty being the pivotal point, whether it's binding or not. So maybe they feel like 5% is painful enough to be binding.
You're right.
But
now that you say that, I remember hearing that too.
Okay, so you're saying that there's some penalty that they could pay on the IRS side, or you're talking about this was just something mentioned in a contract?
If the penalty to walk away is like at least 5%, like significant enough, like then it's considered binding because you are taking a blow to walk away at that point.
But is that written? Is that written somewhere?
Yeah, it is usually when you buy a house. So you usually put down money. So
no, I mean, is that written somewhere in like the IRS side that is
it must
the
be
5% is the rule?
It is. I know this, Richard. I mean, I would probably never be able to find it right now, but now that Don said that, my like memory is triggered. I do remember that being some like 4-part test type thing or something that was brought up as something that says, yes, this is binding if the penalty was a certain threshold.
Right. Okay. So there you go. I mean, that's if there is something written and that they can point to, like, well, you haven't looked at this section where it says that if it's more than 5% to walk away, then that's a binding contract under the rules. Yeah. All right. So I was about to turn this into like a bit of a relativistic terms, but I still think it is. I mean, and this points back to what John said. I mean, there's lots of people that are going to push back and they're going to say, I don't like that. And we want to do it a different way. And if their CPA is like, look, this, I want to make this client happy. You're just there to consult and say, hey, look, we're trying to keep you guys out of trouble. Here's the information, and then you can kind of do with it, as you see fit. Thank you, Jonathan. We had a couple of, let's see, you have inspection periods, loan approval, et cetera. I'd go with the close date. Generally, blinders don't come close to 5%. There you go. There's other evidence there. So yeah, or other things that to consider. Thank you for that, Mark. And then Mike wrote, so on the conversion to rental, do the related party rules related to bonus depreciation not apply? On the conversion to rental, do the related party rules related to bonus depreciation not apply? Mike, do you want to get on and maybe clarify that a little?
Yeah, I guess my understanding is if you acquire property from a related party, you're not allowed to take bonus or 179. So I don't know if this would qualify, be determined as an acquisition, or since you technically acquired the property way back when you bought it, you just change in the use of it.
Yeah, so you're the same owner though, Mike. So I guess there's not a
I don't know. I haven't looked into it. I was just curious if anybody knew for sure. I mean, I can understand what you're saying, Don. That makes sense. But I just wanted to make sure that wasn't walking into something.
feel like I heard something about that, and actually I feel like maybe that came up on the ASCSP call, but I feel like you could, my opinion. I don't know if I have a basis for that, but I don't think, well, transferring it into an LLC that you own is different. Yeah. The related party rules just keep you from, transferring it to your brother or transferring it back. It's that kind of thing. And then trying to place it in service a different date. I mean, I had a client ask me that, just today that, oh, if they then transfer it to their trust, could they then, get the 100% bonus, even though they had placed it in service, before. So the answer is no. That's what's keeping you from doing that kind of thing.
That answer your question, Mike?
It does, thanks.
Great. Sorry, I just saw a question come up. Yeah, there'll be a link to the recording afterwards, guys. Just to as usual with all these calls. Okay, so I think let's move on to real estate professional status. Who really qualifies, how to pass material participation test, why it's an essential unlock for accelerated depreciation. John, once again, we will lean heavily on our CPA expert here. What is it most important to know about rep status?
What I tell everybody, the absolute most important thing to know is that you cannot have another full-time job. Because if you get audited, the first thing the IRS asks you is, do you work at the bank full-time? And you say yes, and they say, then you are absolutely not also a real estate professional. So you will never be real estate professional in the eyes of the IRS unless that is all you do. And then if that's the case, then you've got to meet the time tests, the 750 hours, you got it. And then you've got to document those. And a lot of people don't want to hear that. Doesn't count, travel time, because you've got to document that's what you're doing. If you're a realtor or you're a broker, you don't have to document because it's clear that you're earning, just the fact that you're earning income and you're making money from deals all year, that's enough for 750 hours. So that's the biggest thing for rep status. But the other thing is that if you have a husband and wife, one of you can be rep status and it counts for your married filing joint return. So that's why you have all these doctors that then the spouse is investing that money in real estate, becomes a real estate professional. They use that. They make all of the losses from the depreciation from the bonus offset the active income from the doctors. And you can do that. That's the way that works. Asher has a question. Yeah, I think I'm confused by
I think the question, Dawn, was, could a cost seg firm be eligible as a real estate professional?
Oh, no. No, there's specific, there's a specific list as to what qualifies and what doesn't qualify. I think a cost seg firm is
Stretch.
I think that's a stretch, yeah.
Yeah, Asher, I mean, if you have any other questions about that, you can definitely follow up.
No, I was just piggybacking off of Mark.
Yeah.
Well,
Just
yeah,
saying that
because
if
you're not owning real estate. You're studying real estate, but it's somebody else's property. You're not.
there's a case where an appraiser only lost because they for some other random reason. So if appraisal, I'm just the argument for it maybe is if somebody only loses because if an appraiser could win, so maybe the actual engineer could maybe qualify that. But I'm not looking to ask the question. I don't think I would qualify as running the firm, but
Yeah, I
it's
think
just
that,
food for
I mean,
thought.
it's true that like a broker, they're brokering for others. They don't necessarily buying and owning for themselves. It's two different things. So I looked up, because I can't find my sheet, but brokerage, development, construction, leasing, if you're leasing, you're not buying. So
Are you
think
saying
about
like the leasing agent is a
the
real estate
leasing
professional?
agent. Mhm.
Oh, wow. So just, wow. Okay.
Yeah.
So like even that doesn't include like apartment leasing agents all the way, does it? Like
Um,
somebody working in the front office of an apartment complex and be like a real estate professional?
no, I would think their job is just
Right. Showing, right.
meet and greet, or that's different.
Yeah.
It's I'm sure there's gray areas in that. I haven't had anybody ask me that, but the leasing, if you're doing, so a lot of times when I think about that, I think about drawing up the leasing agreements, brokering the lease, or the lawyers who are drafting these things, then are the lawyers in real estate. I'm not so sure. They're in the profession of law. So I am sure that people have pushed the buck there, but this is what's listed as allowed, and it's not cost seg professional. So just getting back to that question,
Right.
I'm just gonna leave it
Yeah.
at that.
Yeah. I mean, look, we'll wait until you force the issue there, Usher, and let us know how the court case goes. Okay. Looks like Peter Fulkins raised his hand. Peter, do you want to go ahead and just unmute and ask a question? Peter, still here? Maybe he had to leave. Who knows? Peter, are you still here? No, he must not be here. So something he must have had to leave.
Maybe
Oh,
he
allow to talk.
actually
Here we go.
clicked the button.
Oh, I just allowed you to talk. Oh,
Can you
asked
hear
to
me
unmute.
now?
Yes, I can.
Okay,
Okay.
I just got the unmute, the ability to unmute was sent to me, I think.
Yeah,
but,
sorry. Go ahead.
I can't speak for every state, but I can say that in the state of Washington, a real estate professional is generally defined by being a licensee. So that means that you passed your real estate test and you're currently carrying a real estate license. So that would include a leasing specialist or someone involved in purchase and sale, but you're a licensee.
Interesting.
And
Okay.
a lot of property managers are also licensees, because in this state, you are not allowed to negotiate on behalf of another person. In other words, as
Unless
an
you're
agent,
licensed.
unless you are a licensee or an attorney. I just wanted to throw that in.
So what if you're an attorney that deals with real estate? Is that covered?
Yeah, if you're an attorney, you are, also by law allowed to negotiate on behalf of another party. So
So that's interesting though. But what if you don't do any real estate contracts, but you're still an attorney? Is it just because the prospect there is there? Do they still qualify?
yeah, they still qualify in Washington. It
Wow.
doesn't distinguish between real estate attorneys, land use attorneys, litigators.
I've got a marketing campaign idea for anyone who's selling, real estate or projects that require reps there or status, or I guess just in general. I mean, for cost sake, just go out and be like, hey, all the attorneys need to come to this lunch and learn. But yeah, no, that's interesting. So I wonder if that would be apply even further. I mean, that's something else we should probably look at. Anybody could look into in different states and see if any lawyer, because they have the ability to sort of negotiate or what is it, litigate in some way, or negotiate on behalf as an agent of a buyer in a real estate transaction. Does that make them a real estate professional? Interesting question. I don't think we have the answer to that.
So
Go ahead.
this is a much bigger deep dive here. I mean, because so in that example, let's say, Peter, you qualify under Washington rules for reps, but you do not qualify under federal rules for reps. So now you filed your federal return one way, and then how are you going to file your state return? First of all, you have to see if your state return actually even bifurcates the passive and the active the way that the federal return even does, which a lot of them I don't think do. I think for a lot of states, it's just lump income times the tax rate. So it may not really matter. So I would have to see how that plays out. And actually, you don't even file an individual return in Washington. So what
That's
are we
right.
talking about?
There's no state income tax in Washington.
Oh,
Yeah, you just
whoa.
have the P&O tax in Washington on businesses. So yeah, so
I guess
it's not going to help you at all in the state of Washington.
Yeah.
Okay, yeah, so that doesn't matter at all then. So because this has to be, and so I mean, what the letter of the law, and I think you just read it out, right? Don was essentially somebody who, and I don't know if you want to read it again, but maybe we'll go back to it. But okay, sorry. So I thought somebody had a question about states.
The professions that count: construction, leasing, brokerage. Those are the obvious ones. Realtor. If you're acquisition, if you're you have a portfolio and you're constantly acquiring real estate, you've got to be spending 750 hours or more in real estate. You have to be able to document and substantiate that. And the first thing I will tell you is you can't have another job. You can't have a W-2 job at all. Even though the 750 hours, you can't, per the law, you could technically work 40 hours here and then still put in 750 hours over here. But I'm telling you that I think almost every
They don't like it.
who's gone to the IRS with that fact pattern has lost.
But if but let's say you're getting it, like I'm a mortgage broker and I pay myself through a W-2, then that's fine.
Yeah. Oh yeah.
Okay.
Yeah.
So it's if you're in one of those obvious things and you're also getting a W-2 through that same way, that's not an issue.
That's not an issue. No. It's you work at a different place, doing
Right.
a different job. You're a software developer.
Your day job, right?
Your day job's different, right? That's different.
Let's see. Got a couple of comments here. Does fire restoration count as construction? Good question. And do these things, I mean, it's interesting because these things only come up, like the guidance on these only come up when it gets litigated, right? Like if somebody's like, I'm a fire restorer, and so I'm claiming that as rep status. And I mean, would this be something that that would be covered under, the way it's written now, or would have to just be litigated?
And if you do construction, like renovations, I mean, if you're restoring,
They are renovating.
and renovating after a fire, just that was the catalyst and all of your work is that, then maybe, yeah. I mean, I don't know. This is probably one of the most litigated areas in the tax code.
Sure. My cost
Jonas,
segs
did you
are
have a
all at
question?
night.
No.
Oh, Jonas is saying for W-2 to qualify for reps, you need to own 5% of the company. Jonas, you want to just come on and just maybe expound on that?
Yeah. That's to my understanding that the only way a W-2 would qualify for reps is if you have a good ownership in the company, which qualifies on the IRS as 5% or greater. So if you're a real estate agent that is not a 1099, it is a W-2, that doesn't qualify.
Are there real estate agents that are W-2?
Yeah, I have one. So yeah.
Yeah. So that does happen. So yeah, most of them are 1099s, but I guess that's a good point. I mean, so I guess.
True.
Huh. Yeah. Okay, let's move on to our last topic because we are at the bottom of the hour now, and we have one more topic we haven't touched.
Oh, I just want to give a laugh about how Mark said that he only does his cost segs at night, so his day job won't count anyway toward it. But Anyway, all right. Short-term rentals is the last thing. So cut through the confusion around the short-term rental loophole, passive activity rules, how to structure depreciation for maximum benefit. Dawn, take it away. We don't have very long. Please stay on if you would like. Otherwise, it'll be part of the recording.
Yep. I mean, there's a whole litany of rules here of how you qualify for the short-term rental loophole, which, you know, you can look up, readily available. But the biggest things I see people doing, and the biggest things, way I think to grab this opportunity is you're renting short-term, on average 7 days or less, you know, never more than 30 days. There's a 30-day thing in there, but just think about the 7 days or less, and that you're doing substantially all the work yourself. So if you have a management company, you will not qualify. It's going to throw you out right there. So you have to be the one talking to people on Airbnb. You have to be the one doing more work than anybody else. And that includes the cleaners. And that doesn't include travel time to and from your place. Your place is at the beach, 2 hours away. You can't factor that in. So if you're cleaning yourself and if you're talking to people yourself and it's short term, you absolutely can do the loophole. But if you're not, if you don't have a management company and you hire cleaners, then you need to document that you're putting in more hours doing everything else than the cleaners are cleaning. I have heard of people tell me that they've been told to use different cleaners, so they did more hours than Jane and Joe. And I think that's a little bit of a stretch, but throw that out there, but that's the idea.
Yeah, I wonder how many people are adhering to that. That's I'm sure, yeah, not many people are like, but and look, I don't want to, I also don't want to have you guys tempt your clients, but you know, there seems like a workable gray area there where that does not need to be the permanent state of things. And Dawn, I mean, from what I've understood is that you could, you know, look, you're cost segging it, you know, this year. If you're doing substantially everything this year, and this is the year that you're filing the cost seg, then you can qualify for short-term rental status this year. You don't have to qualify. It doesn't have to qualify the next year or the year after for you to take that benefit this year. So, you know, the pain can be temporary, is kind of the point. Does anyone go ahead?
If you place it in service later in the year, then you only have to do all that stuff for a shorter period of time. But the 12
December
months,
1st, December 31st. Perfect.
That's one of the biggest things of the bonus, you know, is that you get it even at the end of the year. You put your property in service on the 31st of December. Boom, you get the bonus for that whole year.
You put up the Airbnb page, and that was all you did, but that was substantially everything because it was the 31st of the year.
Available
look,
for rent.
Yeah, exactly. And you know, that is, you know, everybody's got to be able to stand behind whatever they recommend to their clients. So that is, you know, take that for what you will. Dawn, could you group STR and LTR to get around passive rules? Ooh, probably not.
Group LTR and group them with a grouping election.
I think that's what he means. Yeah.
So the grouping election is for businesses that have like owner operator, and then you've got your real estate that you're like in the example of the manufacturing. I don't think the grouping elections apply to when you have a bunch of rentals, unless you're doing
and I also
asset
isn't this at the tax level? I think it's at the tax. It's like flow through tax anyway, right? So it's like, okay, like the way that you're going to pay the tax from this thing, even though they're grouped, it's not that that you would change the way that the taxing works. It's you're going to pay passive or whatever, you know, even though they're grouped together, it wouldn't change the way that it gets looked at is kind of what I was thinking.
Well, the grouping election, okay, I think the grouping election though it does do that for a business. So this happens,
Okay.
you know, where in the grouping elections is actually a whole different conversation. But if you have a business, so you have a dentist, they bought they're doing their dental work and then they bought their building, but they put it in an LLC, they can group those two activities together because they do want to take that cost seg, you know, and against their active business, and that real estate is passive by, you know, immediate nature in the IRS. So that's where the grouping election, but you can't do that among just different pieces of real estate. It has to be an operating business that you're pulling it into the real estate that the operating business is using.
So what if you have two operating businesses, one with the long term and one with the short term, and then you group those.
But you're saying that both of those are, you don't have an operating business there. You're saying your business is rental real estate. So there's not a grouping election for rental real estate. That makes sense.
Okay.
It's only to bring real estate into an operating business, like a dentist or a manufacturing facility or a, right? I mean, unless
Okay, I see what you mean.
Yeah, unless
No,
I'm
I think I think I see what you mean.
something, but yeah,
Right.
I've never.
The
Jonas?
operator part of owner operator is what you mean. Okay.
Mhm.
I'm just thinking more esoteric.
So
Let's see.
Jonas is confused. What is it, Jonas?
Well, I mean, so you're right on the operating entity, but what if they have a property management company that qualifies for an operating entity under the
Right.
IRS's rules? So why couldn't you? So my question is, I have a client that owns multiple print properties, short-term and long-term, and their CPA, because they want to do a cost segment on 4 of them, and their CPA says, well, if you group them all together with their property management company, is going to equal the 750 and 50% rules to make everything rep status. So
And
they're
that's
using the
possible.
hours.
That's possible.
Yeah.
I would have to, a lot of times like that, I just researched that fact pattern. So I have not had that question come up before, I will admit. So it's very possible. That's interesting.
Do we want to, maybe we can, something we can even, talk about offline if you want, Jonas. If you'd like, just contact us and we could maybe go back and forth on that because it sounds like an interesting question and something we could also answer the next time, or maybe on an email that goes out to everybody because we are 6 minutes over here. Does anyone have a last minute question to close everything down? Okay. Well, thanks. Thank you, Don. Thank you, John, for showing up here, and thanks to everybody else for coming. And yes, please look for the recording should be coming out shortly. Okay. Thank you, everyone.
Bye, everybody.
Bye.